We are in a Great Depression kind of situation. It's not as bad as the Great Depression for most countries, but I should say for some of the European countries, the downturn is worse than the Great Depression. And the only way to describe what is going on in several of the European countries is depression. And that lasted a long time. And the only way the world got out of the Great Depression was World War II. And the reason they got out of it was massive government spending. It was the opposite of austerity. It was not a good reason. We would have done a lot better if we had spent the money to create infrastructure, education, technology, rather than bombs. But it was government spending that finally got us out of the Great Depression. The countries were sufficiently diverse that to share a single currency was going to be very difficult. You were taking away two of the adjustment mechanism, interest rate and exchange rate, and you didn't put anything in its place. But you were other problems. I talked about the problem of the instability of capital flows. A single market without a common banking union was a flawed financial structure. When you had a problem in a weak country, capital moved out of the country and made the country weaker. So you had a system of divergence when you needed convergence. You needed industrial policies to help the poorest countries catch up with the rich. But you had a framework that made industrial policies more difficult. You had an ECB that focused on inflation, when the fundamental problem around the world was not inflation. It was unemployment growth, financial stability. It was not focusing on the right problem. The theory was that if you kept inflation low and stable, it was necessary and almost sufficient for economic growth. That theory was wrong. It was known to be wrong before the euro. But after the crisis of 2008, everybody should have known that it was wrong. The United States had low and stable inflation. And did we have high growth and stable growth? No, we had a crisis. So I could go on, but there are many of the theories that were in place at the time the euro was created that were just wrong. And they were very influential. One more. A theory that was very strong is that all you needed to do for the individual countries was to avoid big budget deficits and debts as relative to GDP. That was the Maastricht Growth and Stability Pact. Ireland and Spain had a surplus before the crisis and a low debt GDP ratio. Did that prevent them from having a crisis? Would today, if other countries had a low debt deficit and debt, would that ensure that there would not be a crisis in the future? No, absolutely not. And every economist knows this. And yet, the policy framework hasn't changed. So that's what I meant by the structure of the euro. Now, combining that flawed structure with flawed policies has been devastating, because austerity, the basic problem in the global economy and in Europe is lack of aggregate demand. Lack of demand. The productive potential of Europe, the quality of the human capital, is good. The problem now is lack of demand. And what does austerity do? Take away demand. Now, there have been a few cases of small countries where, as governments have cut back, exports have expanded. But those have typically been small countries where their trading partners were growing rapidly. But Europe is a big economy, and the global economy is not in good shape. So I don't know where you're planning to export. Maybe Mars or Moon? But there's a slowdown in Asia. There's a slowdown. The United States is not growing. The United States is trying to export. Everybody wants to export. But where are they going to export to? So and if you look at the data for Europe, it's actually quite striking. Current account balances for the periphery look better. But why? Is it because exports have gone up? With a couple exceptions, the answer is no. Exports have not gone up very much. The answer is imports have gone down. And why have imports gone down? You starve an economy. If people's income, as in Greece, has gone down 25%, guess what? If you starve them, they don't buy as much. And when you don't buy as much, you don't import as much. So it's a starvation thing that improved the current account deficit, but it's a beggar thy neighbor policy. It hasn't strengthened the other countries. It reduces imports, it doesn't increase exports.
Market design is, of course, an ancient human activity. People have been building markets for as long as there's been agriculture, at least. Only recently have economists started to feel that we start to understand enough about this that sometimes we can help. Because markets otherwise evolve by trial and error, and there can be long periods of error. A couple of things have happened in financial markets. One of them is, what is a bank? There's a sense in which we used to say a bank is a company called a bank. But maybe anybody who borrows in the short term and lends in the long term is a bank. They are performing banking functions. And maybe we should start to regulate all the financial securities that do that a little as if they are banks. Similarly, things that form insurance. When you have insurance companies, there's over the years built up a lot of understanding that risks that an insurance company can take on should be independent of each other. But various kinds of financial insurance instruments turned out not to be independent of each other, not to be insuring independent risks. So we need to understand better. We start to understand better how to investigate those things. Now, while we're still on financial markets, many of the simple rules of design were made when people did all the trading. Now computers do a lot of the trading, and that changes the speed and it changes the manner of competition. And so Eric Budish at Chicago, a student of mine, for instance, has been studying how we get market failures due to high-frequency trading that didn't used to occur with the old rules that were very adequate for low-frequency trading, and how we might have to change the rules to accommodate to the fact that trading can now happen much faster and competition can be on speed instead of on price. So those are new ways to think about markets that come up because of the ways the markets have evolved. We've started to learn more about what marketplaces have to do in order to make markets work well. And so marketplaces have to assemble enough people to make the market thick. They have to, once the market's thick, they have to deal with congestion. When there are lots of people in the market coming to the marketplace, it's hard to deal with them all, to evaluate all the transactions that you have to evaluate. So the marketplace has to help them do that. It has to be safe to reveal the necessary information and participate in the market in a way that lets it reach an efficient outcome. And what my colleagues and I have particularly focused on is many markets don't work like commodity markets. In a commodity market, price does all the work, and the job of the market is price discovery. So in the New York Stock Exchange, the job of the stock exchange is to find a price for each security at which supply equals demand. But in the employment market, that isn't how people get employed. The big companies with desirable jobs don't reduce the wage until just enough people want to work for them. They keep the wage high enough so that lots of people would want to work for them, and then they decide who to hire. And they can't just choose who to hire, they have to compete with other companies. Universities don't raise the tuition until just enough students want to come to the university. They keep the tuition low enough that many students would like to come, and then they select them, they admit them. So these are institutions that are matching markets where they're not anonymous, the way a stock market would be, a commodity market. If you're admitted to college, you personally are admitted. If they're not anonymous, and price doesn't do the work. They don't set a price so that supply equals demand. So So they have other institutions of market clearing, and sometimes we can make those work better so that they help make the market thicker and deal with congestion and make the market safe to participate in. Financial crises, in part, result from financial innovation. At the time of the Great Depression, we discovered that banks needed to be regulated, that insurance companies needed to be regulated, and we developed systems of regulation, different ones in different countries, but similar, that banks had to have capital reserves, that insurance companies did as well. Now, over the years, people invented new financial instruments that allowed them to perform some banking functions without being called banks, and some insurance functions without being called insurance, and so they escaped the regulation of banks, and they functioned differently, and partly they were designed to accomplish new things, and partly they were designed to be unregulated. And some of those have failed. Some of them turned out to be insurance products that weren't regulated by insurance regulators. Maybe they were lightly regulated by securities regulators. Well, as we understand better how they work, we can think about how to regulate them. And I think that's a natural part of the evolution of markets, as people develop new products to sell, new financial products to sell. We learn how they work and how they fail, and then we think how we should regulate them, what the rules should be for these products to make them more secure, to make them safer. Remember that not every market is a commodity market. So often when we think of commodity markets, we think they remove personal relationships, they become anonymous and arm's length and change people's relationship to each other. But think about labor markets. When you get a job offer, it's you in person, you who have gotten the offer. Someone wants to hire you, not me. So I think of markets as a very broad class of human activities, and again, very ancient. When you look at Stone Age tools, you find them distributed far from where they were quarried and made. So even before the invention of agriculture, human beings were trading with each other, and we don't know quite how they organized those markets, but you can see that the tools traveled thousands of miles from where they were made and where they were built. So I think markets are like language. They are ancient human artifacts. They are things that people make and have made for a long time. They're part of what people do. One of the things we're seeing are MOOCs, classes taught on the internet to very large numbers of people. Certainly there's a increased availability of certain kinds of education that way. My colleagues and I have been involved in school choice in a number of American cities for primary education, for public education. And that's a way, that's like kidneys a little bit. That's a marketplace where we don't want money to decide which children should go to which public school slots. But we would like to assign school places efficiently. What's a shame is if your child is going to a school that we really wanted our child to go to, and at the same time our child is going to a school that you really wanted your child to go to. So there are benefits of running a marketplace that takes these things into account, even though it can be one that doesn't use money. So just incidentally, when I speak about matching markets, these more personal markets like labor markets and college admissions and school assignment, I'm speaking about markets that even when money is present, as in American universities, it's not decide who gets what. It's not used to decide who gets what. So Stanford University, where I teach, doesn't use tuition to equate supply and demand. It doesn't raise the price until just enough students want to come. It's expensive to go to Stanford, but it's cheap enough so that lots of people would like to come. And we have an admissions office that admits some, and there's a whole market procedure of applications and essays and interviews. And so markets like that are more complex than commodity markets. They need more design in order to clear well.